Hey YouTube investors, hey stock market sharks. I'm Steve, your fellow stock market shark, and today I'm back with a very important update on one of our favorite stock that probably many of you trade. I'm talking about Alibaba, company ticker BABA or BABA. Guys, so many of you have been texting me or writing me in the last couple of weeks, asking me about my opinion of Alibaba. You've been asking me constantly if this stock has potentially bottomed out, if you should consider buying the dips, if the stock might have a considerable upside potential in the upcoming months or years. So guys, today I'm here to bring you the answers to these questions, to reflect on the recent headlines related to Alibaba, and to give you my insights on the valuation of the stock. So what you would get, guys, in this video is a review or a reflection on the most important headlines, and most importantly, the headline that you can see on the screen. Alibaba has basically been hitting a 4-year low in the recent trading session, and Goldman Sachs maps out how the stock can rise in the future. So we are just getting started, but before that, guys, please make sure that you hit the subscribe button if you would like to see videos like that. I'm covering popular stocks. I'm doing fundamental research, fundamental analysis, completed with technical analysis. So you guys would get a holistic picture of the stocks that I'm covering. I'm coming from time to time with the most popular tech stocks, EV stocks. So those picks that most of you might be pretty much interested in. So guys, if you don't want to miss any of the future videos, any of the future updates, you would get to know my insights on the most traded and the most popular stocks, then please hit the subscribe button. Please make sure that you support the channel and help me grow this community, because don't forget that trading together is much more fun than trading alone. And now we can get started. Let's look into the headline and let's look into the valuation of the BABA stocks. Here we go. So as you can see, guys, the technical chart for Alibaba stock just looks horrible. The stock has undergone a massive correction. You can see this part of the chart, and it has been hitting a 4-year low just in the recent trading session. The stock has been hitting an all-time high earlier last year, around October 2020. This high was around 320 USDs, and since then the stock has been undergoing a massive correction, and now we are around 130 USDs. Let's just look at the performance in the stock in the last 1 month, last 6 months, and last 1 year, to just basically have a starting point for the discussion, just to see how much Alibaba stock has corrected. So in the last 1 month, the stock is down almost 20%. So it just looks horrible. But this becomes even more severe if you take a look at the last 6 months. In the last 6 months, the stock has corrected almost 40%. And in the last 1 year period, the stock is down more than 50%. So over a 1 year period, the stock has lost more than half of its market cap. So that's very significant. So something very severe must be going on. And probably most of you guys know what's going on with Alibaba. I think that the main question is how to interpret the events, how to interpret the new data that has been coming out related to this stock. And we are going to look into it in a lot of details. Let's see the first headline that is basically my signal that the stock has been bottoming out. And this is basically reflected as well by the analyst who has done some research from Goldman Sachs on Alibaba. So the headline that has been just released and basically just reflects how severe the situation around Alibaba is, says that Alibaba stock hits 4-year low, and Goldman Sachs maps out how the stock can rise or fall. So a team led by Piyush Mubai at the US Investment Bank removed Alibaba stock from its conviction list, but ultimately maintained a buy rating on the shares. They also cut the price target by 15% to 215 USD from 252 USDs. So with the shares trading below 132 USDs, this is the lowest level in 4 years. That still implies an upside of 63%. The main issue and the main concern of all analysts, and all of them seem to agree in this regard, is that crucially, it looks like the growth for Alibaba is slowing at the company, and the competitors are eating up Alibaba's stake. So basically, the growth is slowing and the margins are decreasing, and the competitors are eating up the margins of Alibaba. And this can be a considerable driver in the reduction of the profits in the next couple of years, in the years ahead. And this is really concerning. So as you can guys see, the EBIT growth, the 5-year average EBIT growth for the stock is more than 30%. You can see the data here, it's almost 32%. And the recent number here is less than 9%. So there's just a huge gap compared to the average trajectory of the company and the most recent number. And basically, this recent number just signals a shift in the narrative. So it's a reality check for the investors. The investors are reevaluating the company's growth prospects, and they are pricing in a much slower growth rate as reflected by the current numbers. So this is the main issue here, the narrative changes. And this is not just FUD, so this is not just fear, uncertainty, and doubt. So this is not just an overreaction of the investors, an overreaction of the market. So the fundamental picture behind the stock has eventually drastically changed, as this can be captured by the most recent numbers. So as you can see, the interpretation of the latest earnings report, Alibaba now expects the revenue for the year ending in March to rise between 20% and 23%. And this is basically the slowest pace since its 2014 stock market debut, and down from the May forecast of almost 30% growth. So that's a considerable change in the narrative. That's a considerable change in the fundamentals here. And for a stock that has been valued based on high-flying growth rates, some very optimistic future, basically this change is represents a massive gap, and it represents also results a considerable pressure on the stock price. And this is basically what happens. Investors started to price in their models these more pessimistic scenarios, these lower growth rates, and that is basically bringing the Alibaba stock price back to the earth. I think that the main concern related to the latest earnings report is that these weaker numbers, that is decelerating growth of the company, is not just for one single quarter. It can become a trend, and it can be systematic in the future. The Daiwa Capital Markets analyst says in the research note that we see intensified competition further eating into Alibaba's market share and widening the difference in revenue growth of Alibaba and peers. So I think that this captures the essence of the re-evaluation of the narrative behind Alibaba stock. So this single sentence describes the bottom line, basically, of the misery that Alibaba has undergone in the last couple of weeks. Of course, among such a heavy market sell-off, the sentiment, the feelings, investor psychology play a crucial role. And of course, the market can detach heavily from the fair value of the stock. So it's very difficult to define where should be that specific point when Baba stock should bottom out. So for this reason, it's very important to do some frequent reality checks, to revisit the valuation of the company, and to have a conservative estimate of how much a Baba stock should be worth. And that's what we're going to do in the next couple of minutes, guys, because this is very important. Probably the market has overshot, and basically it has created some very good opportunities, some very good entry points in Alibaba, but probably the stock can still sink lower based on the recent projections, on the recent growth trajectory that has been projected by the analysts for the stock. So let's revisit the valuation of Baba, and let's check out what's my price prediction, what do the models say about the fair price, about the intrinsic value of a Baba stock. Is this a good buying point, guys? So here we go, guys. I'm coming with the details of the valuation, and let's see what the numbers are in the end. I'm trying to keep this short and sweet because your time is precious to me. So I've collected everything in advance, but every data that you can see on the screen and that would be used as an input to this valuation can be accessed, can be viewed on different public websites, mainly Yahoo Finance. But for the matter of simplicity, I've collected everything. So then we can focus on the numbers and on the valuation itself. And let's see what we get in the end as a fair value for a Baba share. For the sake of this valuation, I'm going to use a method called DCF, or discounted cash flow method. This is a method widely used in the financial industry. For those of you guys who are not familiar with this method, what this method does is that it collects the free cash flows that the company would generate in the future, and it converts these future free cash flows into the present. And by aggregating them, by adding them up, it will get the value of the share for the shareholders. So for those of you guys who are not familiar with the free cash flow concept either, just very briefly, free cash flow is nothing else than the leftover from the revenue after the company has been paying out its expenses, so capital expenditures and operative expenses. So it's the money flow available for the company for paying dividends, for buying back stocks, for making acquisitions, for investing in the future, and for paying off debt. Now, this model is going to be relatively simple, guys. So we just need a few inputs to run this model. And I'm going to explain you in details what we need and why that is needed. Analysts say that garbage in, garbage out, and the more complex the model is, the higher probability for errors. So this model is relatively simple to be understood, and that's the beauty of it. I'm going to explain all the inputs that we need. Now, the most important thing is the free cash flow in year zero. So the free cash flow at the starting point. I've typed in everything, guys, to save time with it so you can see all the data on the screen. I'm going to reflect on it. So the free cash flow in year zero for Alibaba, this can be accessed on Yahoo Finance, is 153 billion Chinese yuan. So everything, all the numbers all the values that you see on the screen are in Chinese yuans, and also the intrinsic value of the shares that we would get in the end would be in Chinese yuan, and then we need to convert it back to USD, taking into account the current FX rate. That is currently one USD is around 6.18 Chinese yuan. So that's what I'm going to use for the calculation, but it's very important. Everything that you see on the screen is not a USD, it's Chinese yuan. Okay, so we got the free cash flow. And I think that the alpha of the valuation is the growth rate of the free cash flow. So this has a very important impact, a considerable impact on the valuation. So another input is the expected growth rate of these free cash flows. Just don't look at the numbers now. I'm going to explain everything. So let's go to seeking alpha and let's look into the free cash flow growth rate for Alibaba historically and in the last quarter. So here we go, guys. Let's dive into the numbers. And at the end of this video, you will get a stock price, a fair intrinsic value that you should pay for the Baba stock based on my valuation model. So basically what we are going to do here, we would like to get a holistic view of the fundamental analysis of Alibaba. And for this reason, I'm going to apply a scenario analysis. So what we can be sure of that nothing is sure in the future. So there's a lot of uncertainty, not only in regards to Baba, but also in general when we are valuing a company. I think that in the current situation, a lot depends on how Baba would reply to the challenges, to the troubles that it's currently facing. What would be the strategic initiatives to solve this situation, and how will the company execute on the long term on the back of these initiatives? So I think that this is the main question, and this can have multiple outcomes, and there's some uncertainty related to how the company would execute. So I would like to reflect this in the valuation itself. So that's why I'm going to run 3 scenarios in my model. So we are going to run a bear case. That is going to be the less optimistic scenario, assuming the slowest growth rate of the free cash flows per share in the next 10 years. We are going to run a bull case that is going to assume a higher growth rate in terms of the free cash flow per share growth for the next 10 years. And we are also going to run a neutral scenario that is somewhere in between the two extremes, which would assume a moderate growth rate for the free cash flow in the next 10 years. As you can see, guys, the free cash flow per share growth rate is defined by multiple metrics. So we can use multiple metrics to capture the growth rate of the free cash flow per share. We have the free cash flow per share growth rate, and we have a levered free cash flow growth rate. I'm going to stick to the free cash flow per share growth rate because this is also accounting for the dilution of the shares. So basically, this is dividing back the free cash flow growth rate with the number of shares outstanding of the company, while the levered free cash flow growth rate is not taking into account this dilution. I think that the metric that is taking into account the dilution as itself is a more objective metric of the free cash flow growth rate, because we are talking about per share value. So we want to define the fair value, the intrinsic value of a share. So that's why we are also using metrics, growth rates that apply on the per share basis. And as you can see, guys, the latest number, the latest FCF per share growth rate is slightly above 5%, while the 5-year historical average is almost 20%. So as you can see, guys, there's a huge difference in there. So we are talking about almost 15 percentage point difference between the historical average growth rate and the latest number. And this highlights once again the trajectory miss of Alibaba. So this highlights once again the slowdown that this company has undergone. And for the bear case, I'm going to assume that the company wouldn't be able to solve the challenges that it's facing. The competitive pressure is going to be the same or eventually higher than currently. And the company could not improve its growth rate in the future. So this is a pessimistic scenario, and I don't think that this is going to be true, but it's very important to capture this scenario as well, given the uncertainty in the future of the company. So for the bear case, we are going to assume a growth rate that is similar to the recent number. It's going to be 5% over the next 10 years. And now let's switch to the more optimistic scenario that assumes that Alibaba, with some strategic initiatives, with some investments, with reevaluating its strategy, will be able to return to its historical growth rate of 20%. So guys, you can be sure about that Alibaba is analyzing the situation and is working on the next steps to solve the issues, to solve the challenges that it's facing. It is possible that the company can manage the operations in such a way to return to its historical growth rate of almost 20%. I don't think that this is going to be the most likely scenario, as we are talking about changes in the market structure and changes in the competitive edge of the company. And this seems to be a systematic change. This seems to be a long-term issue for Alibaba, but we can't exclude that because Alibaba is just a huge company with a huge potential and eventually can come up with very effective next steps to solve these issues. So in this scenario, I'm going to assume that Alibaba would be able to return to the 20% free cash flow per share growth rate on the long term. And now let's switch our attention to the neutral case. I do think that the neutral case is going to be the most likely scenario among these three. So I think that for sure, Alibaba is analyzing the situation. Alibaba is working on the next steps. Alibaba is working on a reply to basically boost its performance once again, to increase the growth rates, to increase the margins, to gain competitive edge over the other market participants. And I find it very likely, given the resources that it has, given the successful people that it has, given the huge market share that it still has, that it would be able to give a successful reply to these challenges, and it would be able to increase the margins, to increase its stake once again, to increase the growth once again. I do think that we are not able to go back there when we were a few years ago to the 20% growth rate, but a considerable improvement, I think it's very likely. And for this reason, I'm going to assume a growth rate for the neutral scenario that is in between the two extremes, the 5% and the 20%. So I'm going to be quite moderate here, and I'm going to assume a 10% growth rate for the long term, for the future. I think this is something not really unrealistic. So I think that this is kind of like a likely scenario. And now we've covered all possible outcomes from a high level. So like bear case, positive bull case, and neutral case. And now let's dive into the number and let's see what all of these scenarios give. And in the end, we would receive an intrinsic value of the shares by averaging out these three scenarios and having an average outcome. So let's see what we get. So let's run this first scenario as a first step. Guys, I've typed everything in, so we are not required to get the numbers from Yahoo Finance and waste time with typing everything in. So what you see, the free cash flow of the company is 153 billion Chinese yuans. The total cash of the company is 459 billion Chinese yuans. The total debt of the company is 151 billion Chinese yuans. The total number of shares outstanding currently is 2.7 billion shares. And now let's run the first scenario. The first scenario is the bear case. This assumes a long-term growth rate of 5% in line with the latest numbers reported by Alibaba. I'm not applying a margin of safety here, and the intrinsic share value that we get is 910 Chinese yuans, 910 Chinese yuans. So let's convert this one into USDs. So this will represent an intrinsic value per share of 147 USDs with an upside potential of 13% compared to the current prices. So even the bear case reflects a more than 10% upside potential. Now let's turn our attention to the bull case. The bull case, as mentioned before, assumes a growth rate that is in line with the historical growth rate of the free cash flows for Alibaba. It's around 20%. Let's see the numbers that we get for this scenario. So the intrinsic value per share for an Alibaba stock is 2,289 Chinese yuans. Let's translate this one into USDs as well. This is a 370 USD share price with an upside potential of 185%. So a share price of 370 USD, upside potential almost 200%. So this is quite convincing, I would say. So if by some means the company would be able to return to its historical trajectory, to its historical growth rate, then the upside potential in Alibaba is just massive. And now let's examine the neutral scenario. I do think this is the scenario with the most likelihood. I'm assuming a 10% growth rate here. Let's see the numbers that we get in this case. So in the neutral scenario, the intrinsic value per share in Chinese yuans for Alibaba is 1,223. Let's translate this one into USDs as well. So in this case, we will get a share price of 182 USDs, and this represents an upside potential of 40%. So we've covered all three scenarios. We now have a holistic views of Alibaba's future trajectory, of Alibaba's future growth. So the last step is to average out these scenarios and get an average intrinsic value per share and an average upside potential. And this is going to be the indication of our price target. So what we got by averaging out is an intrinsic value per share in USD of 233 USDs with an upside potential of almost 80%, guys. So once again, the average intrinsic value based on our model, based on our calculation, is 233 USDs with an upside potential of 79%. So the recommendation based on this calculation is definitely a buy for Alibaba stocks. So guys, I hope you like this video. Before we leave, please make sure that you subscribe to this channel. We are building this community, this wonderful community from scratch. Don't forget that trading together is much more fun than trading alone. And why it's worth subscribing is that I'm coming with fundamental and technical coverage of very popular stocks, probably those ones that you're also trading. My analysis is always based on best practices in the financial industry. My analysis is based on real data. I'm not just talking about stocks. I'm not just doing investment bullshit, but I'm using real models. I'm using real data. I'm using practices that are used widely in the industry. So if you would like to see coverage like that, if you would like to see stock price predictions, fundamental analysis, and important updates on your investments, then please make sure that you hit the subscribe button. It takes nothing for you, but it just makes a huge difference for my channel. And you would get essential and important information on your investments in the future. So thanks for doing so in advance. And now it's time for me to say goodbye. I will be coming back with the stock coverage of another important stock that is just releasing its earnings report. It's Global Foundries, a Wall Street darling that has been rallying massively in the last couple of weeks after its IPO. Today, the company is publishing its earnings report. So I'm going to cover that. I'm going to analyze the stock. I will be back soon, guys. Thanks again for watching and see you soon. Take care till then and enjoy the trading today. Cheers.